2008, we just hit the ceiling. Just the whole thing blew up. And it was the defining moment of our lifetimes. What had happened is governments around the world had got to roughly 100% of GDP in debt. Now, if you think about that magic formula, that GDP, the GDP growth, is really what drives savings and investments and also pays the interest on the debt. Now, because GDP growth had been falling over the last 30 years, what you found is trend rate of GDP since about the early 2000s had fallen to about 2%. And interest rates were about 2%. Well, they were a bit higher beforehand. 2007, they were 6%. So what happened is there's not enough money to pay the interest. Because if you think about it, GDP is growing at 2%. You need to pay 100%. You need to pay 6% interest rates on the government debt, which is 100%. But the private sector's 100 and something percent in debt as well. So what happened is the whole system broke.
Welcome back to Money 101. In this video, we're revisiting a crucial juncture in economic history, the 2008 financial crisis. Raoul Pal, a distinguished economic analyst, sheds light on the ramifications of global debt levels soaring to 100% of GDP, setting off an unprecedented financial collapse. This resulted in declining GDP growth and escalating interest rates, creating a challenging scenario for governments grappling with debt management. However, this is just the surface. Let's delve deeper into how these events have molded our present financial landscape and the implications for today's investors. Join us as we examine the intricate interplay between economic policies, GDP growth, and their effects on the crypto market. If you haven't done so yet, be sure to hit the subscribe button and give us a like. It greatly aids us in delivering more content like this.
The answer to that was firstly cut rates to zero everywhere. And then it was quantitative easing. And it took me a very long time to understand what the hell this was all about. We kind of knew that they were injecting money into the system. What did it mean? How did it work? Nobody knew. We were arguing about it for a very long time. And it was only until really at about 2020 when we saw the next big wave of... So we had QE in obviously 2009, 10, 11, 12. Then again, I think it was in 14. And then again in 2019, and then a lot more in 2020. And it was observable that asset prices moved every time it happened. And the correlation was very tight. And we were kind of trying to figure out, was this causation, correlation? None of us really knew, but we could observe it. 2020 comes along and it becomes strikingly obvious that there's a bigger force at play here. And I started to realize the force at play here was actually debasement of currency. So people have been expecting quantitative easing to be a inflationary process, i.e. the cost of goods rise, but they don't. The cost of assets rose because scarce supply things, assets, get readjusted in price when you lower the purchasing power of a currency. Now here it's not the dollar versus the euro versus the yen. We're talking basically all fiat currency. The value of it, because there's a lot more of it around, becomes less. And the quantitative easing was the supercharging of this process. So that was basically the defining factor of asset prices. And if you back it out, and we look at Global Macro Investor, my research service, we look at the G5 central bank balance sheets plus M2 for those countries, and we find there's a 97.5% correlation between the S&P and that. It's like, okay, so what we're doing is debasing currency. Okay, so that was that thesis. This is what gave me a lot of the strength to understand what to do in crypto. I realized that crypto was a secular trend driven by network adoption, and a cyclical trend driven by liquidity, i.e. the balance sheets, M2, those kind of things. If you lean into those, you get the big opportunity. My way of doing that was not by trading in and out of crypto. It was just by adding when it all pukes and everything goes horribly wrong, and you're at the bottom of the long-term adoption trend channel, 2 standard deviations oversold. Okay, there's the perfect buy signal if you believe the network adoption continues. And that's worked for every technology stock from Amazon to Apple to Microsoft to everything. They all work the same way. It's like, and once you see this stuff, you can't unsee it. Secular trends, cyclical trends, the nexus, the magic nexus is really an amazing opportunity, which was last year in crypto and last year in exponential age technology and technology overall. What the everything code was me then starting to dig into a chart that I saw that the ISM was perfectly cyclical. Every peak in the ISM, which is my proxy for the business cycle, is 3.5 years apart since 2008. I looked at that and thought, what the hell is going on? Because we were used to remember that long cycle going into the 2008, the great moderation, and now suddenly, like clockwork, the peak of the ISM. And then as the ISM falls, hey presto, back comes quantitative easing. I'm like, okay, what's this all about? And then I stumbled into something that was quite remarkable. I looked at the increase in the balance sheets, the increase in GDP growth. Anything in excess of GDP growth was being monetized, but 3.5 years later. So then I looked at the debt structure of the United States and realized every single man, woman, child, corporation, and the government, and every government around the world, and every corporation reset all interest rates to zero in 2009. It was like a reset. And everybody's got roughly 3 to 5 year debts, and they keep rolling every 3.5 years. So then I thought, I wonder how the interest payments look. And what I found is the interest payments that the US makes, and the EU, and Japan, and the UK were explained by the amount of quantitative easing that happens 3.5 years later. So what I'd suddenly stumbled across in the everything code was the fact that the global central banks had probably agreed together in 2009, 10, 11, 12, probably 2012 after Europe blew up, that with governments at 100% of GDP in debt, they were going to crowd out all the private sector and we were just going to keep having financial crises. And the only way of solving this was putting it on the central bank balance sheet, because there's not enough GDP to pay the interest. So if you think about GDP growth, and let's make the maths easy, even though GDP growth is actually 1.75% average, trend rate in the US, but let's call it 2%. And let's assume interest rates are 2%, which is roughly where they've been since 2008. So if the government's 100% of GDP in debt, GDP grows at 2%, and interest payments are 2%, that's all of GDP growth just to pay the US government debt, just to pay the interest on the debt. So, but the private sector, excluding the financial sector, so households and corporations, are another 120% of GDP in debt. Well, that will give you negative growth every year of 2%, and it just compounds. So what happens is those interest payments just go into the Fed balance sheet and they monetize it. So then the private sector is not competing with the government. And that was provable across all of the major economies. It's like they've all decided that they were too far in debt and the only way of doing this was quantitative easing.
Raoul Pal's examination of the everything code unveils a recurring pattern, the cyclical nature of economic policies and their repercussions on the global economy. This cycle, heavily influenced by the resetting of interest rates and the practice of quantitative easing, holds significant implications for government debt and the growth of the private sector. Here's the intriguing part for 2023. The observed patterns from the past decade suggest a persistent reliance on these economic policies, potentially leading to more foreseeable market trends. For crypto enthusiasts, this could translate into opportunities to leverage these cyclic patterns. To conclude, let's reflect on this. How will the ongoing cycle of quantitative easing and interest rate adjustments impact the long-term trajectory of cryptocurrencies? Could this be the cornerstone for unveiling innovative investment strategies in the digital age? We're eager to hear your thoughts on this matter. Share your comments below, and don't forget to subscribe.